Well, hello everybody. Steven Sitkowski here. Welcome to this week edition of Market Insights. Hope you all had a great weekend. I've got my voice back like 100%. I think last week we were at 90-ish. Um, Feeling good enough. Did a little skiing over the weekend. Hope your weekend was awesome. Had to have been better than current market conditions, right? If not, you need to redo your weekend. So let's get to it. Do a little sharing here with you. Quick reminder that what we do here is for educational purposes only. It shouldn't be considered as investment advice. These are just my thoughts and observations on what's going on in the market. So, what's moving the market? Well, Trump attacks quote unquote loser Chairman Powell. I remember as a kid growing up, one of the things I was taught, you don't do name calling. Name calling is lazy. It's when you run out of cogent conversation. But, that's just me. The implications of this, I mean, the Fed, they're pretty important, monetary policy, trying to keep employment full, keep prices stable. And, people have different opinions of the job that the Fed has done. I mean, frankly, I've watched the chairman, Jerome Powell, navigate us through COVID. We came out of that in reasonably good shape. We didn't tank the economy. Interest rates, I think, are fairly appropriate given where inflation is. But the bottom line is Wall Street does not like uncertainty. And when the president of the United States is going after the Fed chairman, um, it just doesn't look good. And you add to that, what's going on with tariffs, and it creates a ton of uncertainty out there. And look at the market, I mean, what's happening. Markets are down today, and I think the markets have been open now for an hour and a half as I record this. S&P's down over 2%, ditto with the NASDAQ. So this whole strategy isn't working as far as Wall Street is concerned. Now, maybe there's some greater calling out there, and maybe it's going to work, but I have an analyst friend and colleague of mine, and we need to see some deals come together. We've heard about all these countries are calling us, they want to make a deal. Okay, make some deals. And I think that would go a long way to sort of help stabilize the market. But fight with Powell, first of all, the president has no influence over Powell. There's talk about him trying to get him fired. Um, None of that is good for the stock market. So hopefully that clears itself up. I don't want to sound political because I'm not being political. This is not pro or con Trump or anybody else. This is the reality of how these things impact the market. I realize in today's world where, everybody's taken a stand and thinks that their position is 100% right and the other position is 100% wrong. I don't operate that way. I'm not a political creature. My job, it's like being in a helicopter. It's go choo, 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 up, look, observe, and then let folks like you know in plain English what the impact is. The chip sector is in a free fall, including NVIDIA. So you've got these import rules with China, and then there's talk of more competition. So all of that is weighed heavy on the chip sector. 10-year Treasury was up slightly. So, when interest rates are moving up a little bit, it tells me that the bond market is not worried about a recession. So, in that sense, that's good news. And oil prices dipped a little bit. They're at 62.47. Nothing very remarkable there one way or the other. What should we be watching this week? It's a fairly slow news week. So I'm always looking for things that, can influence the markets. So today we've got U.S. Leading economic indicators. Median forecast is that they'll be down 0.5%. Certainly not great. Previously was down 0.3%. Just see if there's any update on actual number. Nope, not as of yet. Tomorrow we got some Fed speak. That's not going to move the markets. On Wednesday, we get the services and manufacturing PMI numbers coming out. We're expecting services to be an expansion, but less than last report. We're expecting contraction on the manufacturing side, but it is only slightly. Fed Beige Book, where they're going to be talking about where they think the economy is. So that could be fairly significant. Get initial jobless claims on Thursday, as we do every Thursday. We're expecting a number of 220,000. That's a strong labor market. Durable goods orders are expected to go up. Those are orders people place for, refrigerators and stoves and televisions. We're expecting existing home sales to dip a little bit. Not going to move the market. And then we got market sentiment coming out on Friday. So I don't think there's anything there of real consequence. I think the primary catalyst for the market will be earnings announcements. So this is last week's heat map. Whole lot of ugly, Microsoft, Oracle. Look at NVIDIA down 12%, Broadcom, AMD down almost 9%, Tesla was kind of fighting its way back. It's now down 10%, Amazon, 9%, Meta, 10%. Now, the good news was Netflix, which announced earnings. So they're up. And then consumer staples doing well. Philip Morris, Coke, Costco, Walmart, PG, all of those are good candidates potentially for covered calls. And here is the 1 year heat map. So more obviously green than red. Kind of a sore thumb over here is Microsoft down 12%. So that's been an underperformer. But again, consumer staples, there's been a movement into safety over the last year. Here's our market sentiment. So it's dipped a little bit. Last week we were at 28.5% bullish. Now we're at 25.4% bullish. We're at 56% bearish. That's come down a tick. But again, a whole lot of uncertainty to the market. How much the Fed's going to cut rate? Here's the latest and greatest. So there's almost no chance that they're going to cut in May. Very good chance that they'll cut in June. So between now and the end of the year, we're looking at 1, 2, 3, 4 rate cuts. And then a rate cut early on in March. So assuming the market's not worried about a recession, these rate cuts should be a great catalyst to the market. So we're looking forward to that. And hopefully by the time some of these rate cuts come in, we have some clarity on tariffs. That combination could be a setup for a very good second half of 2025, which is what I expect. Sector return. So year to date, the S&P is down 11.53%. Only 2 sectors are higher. Again, very conservative: utilities and staples. REITs are almost a break even. Healthcare down slightly. The big losers: consumer discretionary and technology. All right, a whole lot of red flags there. And look at, if you look at their year-to-date price range, look at where consumer discretionary is, way down toward the lows. Let's take a look at the charts. This isn't going to be pretty, but it is what it is. 6-month chart on the S&P 500. So we crossed below the 50-day moving average at 6,000. We're now at 5164, kind of cratered down here below 5,000. We were making a nice comeback. And then again, we're getting hit with all the uncertainty and the infighting, and it is just not good for the market. How do the Qs look? Same deal. So based on all of this, best advice I can give you, stay conservative. There will be a time to attack, and we're going to be able to get into things at discounted pricing. But until we get clarity on the tariffs, get through our earnings announcements, and hopefully stop the infighting, I just think it behooves everybody to be really cautious. Makes sense. All right, I'll be back with you next week. Thanks for hanging out. Until then, be blessed, be safe. Bye for now.